So yesterday we had discussed about the introduction to SA3, what to expect, what subjects we need to have thorough knowledge of, and then we have also completed actuarial control cycle. Just a brief go through that. We had seen one question for actuarial control cycle, and we have done one of the generic questions related to PPO. All good till there. So we'll start today with the revisions for. Yes, Anjali?
No, that turned on by mistake.
All right. So we'll start with the revisions of SP7 and SP8 today. All right. So as I had said previously, that the starting maybe 10 or 12 chapters are almost same. Like not almost, it's completely same actually for SP7 and SP8. So today we'll be going through that. And we'll be doing some questions as well. So the questions can be from any part. It may be SA3 related, SP7, SP8 or anything. Okay, just generic questions. So each class will be doing one or two questions. And you all have to participate in that. I'll just present my screen. You guys have this PPT, right, of SP7?
Yes.
Yes. Okay. So here in SP7 we have the starting, like the first chapter is in insurance companies, then insurance products. We have like chapter 2 and 3, then problem solving, then chapter 7 to 10. So first 10 chapters are same. Then we have reinsurance and reinsurance products, reserving technology, reinsurance reserving appropriate risk and uncertainty data, actual investigation. So if I look at the chapters, I'd say the first part, which is products and markets, that is something that you have to go through thoroughly to have a complete knowledge of the type of products, because we can have a combination of products that might come, or just a suggestion that this type of business exists, what type of product should they purchase, what type of insurance they might need. All right. So if you have a thorough knowledge of what the products are available in the market, or then you will be able to write it. Then reinsurance, you need to know about reinsurance. Like we just had a brief discussion about the type of proportional and non-proportional reinsurance. So chapter 5 and 6 covers those, and some of the questions are also there. So question practice, it's good to practice some questions of reinsurance because it might come up. It may or it might not. But those are basically easy, that these are the layers and these have the claims have come. This is the surplus, the insurer has surplus insurance or XOL. So there are different basic questions to reinsurance, which if you practice, it will be easier and you'll understand the reinsurance better. Then you do not need to have a thorough knowledge of reinsurance reserving. Like I don't think we'll get targeted questions from chapter 24 and 25. Then investigations, risk and uncertainty data, actual investigation analysis. So these chapters also you should go through. So basically chapter 1 to 13, if I look into it. Then going forward in this SP7, we have reserving basis, triangulation methods, basic chain ladder, inflation adjusted, then ACPC, then ACPC is there. We have Bonhoeffer-Ferguson, then we have ELR methods. So those methods are covered there. Are you guys thorough with these methods? Like because not a lot is there in this triangulation methods, only these methods are discussed. And it's a pretty huge chapter or something, if I remember correctly. So if you are just aware of the methods, that will work. Otherwise, you can go through this chapter 15. All right.
Yeah.
You guys know these methods, right? Basic chain ladder, inflation adjusted, and ACPC, ELR method, and then Bonhoeffer-Ferguson. So these are basics. Like I think in almost all the companies, these are used. Okay.
Yeah.
So then reserving basis also, like we'll go through that chapter today. So basically, like in previous session, what we had done is I had just given out this chapters, chapter 1 to 14 and chapter 27 to read. Like So chapter 1 to 13 we have discussed. Chapter 14 is reserving basis. That also we'll go through it. Then triangulation methods, you do not need a lot of knowledge. You must just know what it is and what is covered there. Then capital related questions. So risk. Just a quick question. What are the name 5 type of risks that an insurer may face? Any quick?
Liquidity risk, credit risk, operational risk, in market risk,
Yes.
and insurance risks.
Yes. Right. Okay, so these are by basic 5 risks. So in insurance with risk, we can break it down into underwriting risk and reserving risk. Then operational risk may be of various types. Then, all right. So that's, then we have accounting methods and interpreting accounts. Accounting methods is more towards account based, like CB2, not CB2, CB1, but that was CT2 basically. So that is type of they're covered, and interpreting methods is also, accounts is also covered. We'll add like this. So chapter 1 to 14 and chapter 27, this makes 15 chapters from SP7. So chapter 1 to 14 would be the same for SP8 also. So we'll go through those. Okay, starting with the first chapter, which is insurance companies. So we all know that insurance company basic features are what? They are short term. They are usually of 1 year. There can be multiple claims. Then there may be small delays in reporting and settling of claim. Claim amount and claim numbers are unknown. Yeah, GI contracts, GI products may be divided into 4 parts. So these are basically in the liability insurance, property damage, financial loss, and fixed benefit. So we'll go through each of the products. Like if you go to the PPT, I would not like to go too deep into all the products. It is all the products are covered later in the chapter. Like later in chapter 2nd or chapter 3rd, it's all the products are covered in details. Okay, so liability insurance, we have employees liability, third party liability, public liability, product liability, professional indemnity. Yeah. Property damage, commercial building, motor, marine, aviation, movable property, financial loss, pecuniary loss, fidelity guarantee, business interruption, cyber insurance. So cyber insurance is something new if we look into it. Then fixed benefits, personal accident, health, unemployment. Okay. Then like we'll go through each of the more details and then later. Now, for any organization, there are parts of assets and liabilities. So for an insurance company, without looking through the PPT, what would our liabilities be? Yes. Any guesses? Like if I talk about suppose reserves. So are reserves a liability or an asset?
Liability.
Right. Then we have 2 types of reserve. Basically, there are technical reserves and free reserves. And if we talk about the asset side, we have investments, fixed assets, and net current assets. So this is what a balance sheet of a general insurer usually looks like. Now, understanding the technical reserves. So understanding the technical reserves. So technical reserves can be according to 2 parts. Past events that had already happened, like for at any point we calculate the reserves. It can be 2 parts. Past event that had already occurred up to this point, and future reserves, future events, reserves covering the future events. Now, those covering the past, it could be It would be already reported claims, IBNR, IBNE, like IBNR is IBNER plus IBNYR. Then reopen claim, claim handling expenses, and future events would be UPR and AURR. UPR would be unearned premium reserve so if the policy is not been earned completely, then we have UPR and AURR if we feel that the premium written is not sufficient to cover the claims in the future. Then we will have additional unexpired risk reserve. Are you guys studied with this? Like, I think you might have studied in SP7, SP8, right? Hello? Okay. Yes. So IBNER, IBNYR, reopen claims, claim handling expenses, these all form the part of OCR, outstanding claim reserve, because the claims had already happened up to this date, whether it's reported or not. And then we have for future events, that is UPR and AURR. So AURR exists if URR is greater than UPR. Previously, there used to be claim equalization reserves and claim equalization reserves. No, claim equalization reserves, basically it was allowed under, I think, Solvency 1, but it's not allowed under Solvency 2. Then CAT reserves, free assets, shareholders fund. Now, the claim characteristics, like, do you have the document where I had shared acronyms for some of the important things that we need to remember?
I don't think there's a separate document.
Okay, I'll ask them to share the acronyms file. Is my screen visible? Like, can you see the acronym document? Yes. No. So this is a document which I think you guys might be having. I'll make it re-shared again. So this contains some of the acronyms which is combined from both CP1, SA3, SP7, SP8. So whichever are required, like you might find it helpful in the exams. Personally, I used to find some of the acronyms very helpful. Always remember that, like principles of regulation, of what is the difference between office premium and the rate calculated by actuaries. Then sources of data, risk and uncertainty, for the desirable qualities of exposure measure, stakeholders of a GI company, why purchase reinsurance, external environment, insurability, MUDPIS, then claim characteristics. So if we look into the claim characteristics, this acronym. So whenever we're thinking about any type of product, we'll know that which type of claims are there. So these type of acronyms, like these acronyms, Kraft, Krams, Venn, drill, would help us to write more, generate more points. If you look about how many points, 1, 2, 3, 4. Around 23 points are there here. So 23 bullets are covered here in Kraft, Krams, Venn, drills. So almost all of these will help you with generating points. Okay. Then for claim characteristics, either they can be short tail or long tail. In short GI, what we see is most of the claims are usually short tail. Only some portion is long tail. But for a life insurance company, maximum of the claims are long tailed. All right. Only we have studied that their products can be liability, property damage, financial loss, or fixed deposit. So which one would be considered, like which one is more likely to be long tailed in this? Would it be liability or property damage?
Employer's liability.
Yeah, basically liability claims tend to be long tailed. compared to property damage claims. Okay, moving forward, insurance products. So, what is the criteria for a risk to be insurable? Just quick, anything like this was there in CP1 also, I guess. CP1 April, there SP7, SP8, they have it already.
The insured should have interest in the risk, verifiable,
Yes.
objective, non-manipulable.
Okay. And more points, anyone?
Financially quantifiable.
All right. Okay, so we'll see what are the criteria. Okay. So, as it correctly said, the policyholder must have an interest in the risk being insured to distinguish between insurance and gambling. Like, if I could just insure any other building in the marketplace, and I do not have any interest, so why should I insure that? Like, why would I take out a policy against it, and why would an insurer give me a policy? Like, I would not. If I take out an insurance policy as a policyholder, what my intention would be that this event should not occur. If I take out a health insurance, my intention, I would not want to fall ill intentionally. I would try to avoid it. If I take out a property insurance on a building which I'm living in, so I would not like that building to catch fire or any other disturbance due to earthquake or anything, nothing to happen to it. So we always, as a policyholder, we do not want that particular risk event to occur. Okay, so that is why we must have an interest of the risk being insured. Then risk must be financially of a financially reasonable, quantifiable nature. Because if we cannot quantify the amount that should be given out in the event the risk occurs, then how can we justify it? How will we be able to price it, or how will we be able to decide the sum insured and everything? Then the amount payable by the insurance company in the event of a claim must bear relationship to the financial loss incurred. So in case of fire damage, they'll see how much damage has happened, like this percentage or what percentage has happened. Like they would not give out 100%, even if there is a 10% damage. So the amount payable is always proportional, and or there is some relationship of the financial loss incurred. Now, the basic criteria for a risk to be insurable is MUD-PIS, basically moral hazard avoided, ultimate limit to liability, data available to assess the risk, probability of occurrence should be low, independent risk, similar risk pulled together. Okay, so MUD-PIS, it's an easy acronym to remember. Moving forward. Here are some of the terms which are used in general insurance. So we know what moral hazard is. So party behaves differently in a way they would not have if they were fully exposed to the risk. Nil claims. So what may result in nil claims?
A claim being denied, or it's over the deductibles. Under deductible.
Yes, under deductibles. And denied, why would it be like denied is a very generic term?
Like it might not be within the terms and conditions, like the peril might not be covered.
Yes. In some cases, it might be that they are just reporting it for the sake, like for their obligation of reporting, but they do not want to claim anything. Like in case of, they do not want to disturb their no claim discount.
Oh, yeah.
All right. So nil claims. Claim is found to be not valid, like it might not be valid. Turns out to be greater than excess. Not to be greater than excess, which is deductibles. Has reported a claim in order to comply with the condition of the policy, but has elected to meet the cost in order to preserve an entitlement to no claim discount. Okay, or the sum insured has been exhausted, so no claim would be made. So there will be zero payment there. Then Obermia fights is basically Latin for utmost good faith. that any insurance company, reinsurer, or everything, they would work on this principle. Then insurance company can have multiple claims under insurance. So under insurance is basically if I take out a policy to protect my household items, okay, but I do not know the values. So there is a possibility that the sum insured which I choose might be lower than what is the actual cost. Okay, where the total amount is lower than the value of the item. It may be due to underestimation of the value of insured items. Assessment is because of the assessment that an event leading to complete loss is negligible. Like I might not like if I know the contents of my house is worth maybe 50 lakhs, okay, but maybe I may be too optimistic and think that no, it cannot be possible that the complete 50 I would face a loss of 50 lakhs completely. So I'll take an insurance lower than that, maybe 30 lakhs or 20 lakhs something. So under insurance. So what happens in case of under insurance is the principle of average applies, okay. So in order to prevent under insurance, premium rates are this. So as we said, like under insurance, we get under insurance with what happens. So let me just frame it. So whenever there is under insurance, we take lower sum insured. So why is the sum insured a major thing? Because any payout that happens in case of a risk event happening will depend on the sum insured. Now, if sum insured is less than the full value of the property at the time of loss, the insurance payment will only be in proportion of the value of the loss. Okay, the same proportion the sum insured bears to the full value. This is known as the principle of average. So basically a proportional payment is going to be made. Now, I had taken out an insurance, maybe a home insurance for 1 crore, okay, 1 crore sum insured. But, and the value of my house may be 1.5 crore, okay, at that point. And some event has occurred because of which I had made a claim payment. Now, the claim payment may be of maybe 50 lakhs. So I might not get completely 50 lakhs here, and even though sum insured is 1 crore, because it will work on the principle of average. Now it will work that for a 1.5 crore property, I had taken out sum insured of 1 crore. So in that proportion, that is 1 divided by 1.5, 2/3. So 2/3 on a claim amount of 50 lakhs, I'd be paid 2/3 of 50 lakhs. Makes sense, right?
Yes.
Okay. Then so there is this concept called salvage and subrogation that majorly works in marine industry. So what happens in salvage and subrogation is that the substitution of one party for another creditor. What happens? Suppose there is a complete damage of there is a damage of a ship or something or any particular item. So what happens is the ship is getting transferred to the insurance company. The insurance companies makes utilization of whatever is possible, maybe sell it in parts or repair it and then sell it. So any recovery they make from it is kept by the insurance company and the claim is completely paid to the policyholder. Insurer accepts a claim by an insured, thus assuming the responsibility of any liability or recoveries relating to the claim. For example, the insurer will be responsible for defending legal disputes and will be entitled to the proceeds from the sale of damaged or recovered property. Like they can completely use the ship to maybe sell it in parts or to renovate it and then sell it. So they can do anything with the property they want after that. Okay. Discovery period. So there is usually a time limit in policy wordings under which a claim, like the claim must be reported. Underwriting, we all know the process of underwriting is there for any insurance before any insurance product is written, in which the underwriter assess the risk, make sure that it is in the acceptable, whether it is acceptable or not, decides the sum insured, decides the premium and everything. Okay. Then there are for a insurance policy, we have policy documentations and exclusions. So, what would be covered under policy documentations? Like, Any policy document for an insurance product, what would they consider? What would be covered under?
Premiums, sum insured, perils covered, exclusions, policyholder details like name, age, or whatever is required.
Policy term would be covered,
Policy terms, yeah.
right? So details of what is covered. Then excess applied, any limits, exclusion, time limits, any optional cover, premium paid. Now in exclusions, like some of the common exclusions that we see in almost all the policies are suicide, dangerous pastimes, war, terrorism, illegal activities. All right. Okay. So for key features of products are basically benefits, insured perils, what is covered, basis for cover, whether it is a loss occurring, LOD or loss occurring or claim made basis, then measures, exposure, claim characteristics, risk factor and rating factor. So before going further, what is the difference between risk factor and rating factor?
Rating factors are quantifiable and can be used in premium calculation or any calculations. Risk factors will just used to assess the risk.
So you're correct about the risk rating factor. So rating factors are basically a proxy to risk factors. Like so there are some of the risks, like if we talk about for a motor insurance, the speed with which a car is being driven. Previously, now we have black box and all of these, but previously there was no such things. Okay, so they used to consider, so driving speed would be a risk factor, but as we cannot measure it correctly, so we used to use proxy factors like age, years of license held. So all of these used to be used as rating factors there. Right. So risk factors are the factors that majorly affect the risk, but we use proxy rating factors. Proxy factors known as rating factors, as some of the risk factors cannot be measured directly. All right. So, risk factor, rating factor. Risk factor affects the amount of risk or intensity of risk. They are determinants of rating factors. Driving speed is a key risk factor for motor insurance. However, it is not very easy to measure. Rating factor affects the price and are the factors that can be used directly to determine the premium. Hence, we use measurable or quantifiable rating factors like age to calculate the premium. Okay, so then we were talking about benefits, insured perils, basis for cover. Okay, exposure measure. So exposure measure is very important. So exposure measure. So what is the characteristic? What makes any measure a good exposure measure is Venom ADDA. Okay, where it is verifiable, easy to obtain, non-manipulable, objective, measurable, acceptable to the market, defines the risk, acceptable to the policyholder. Claim characteristics. For claim characteristics, we had a very big acronym, right? This. Please, can you just confirm if you have the acronyms this or not? If you do not have it, like I would like you guys to have it now only, so that you can go through it every day. It's a short document. Okay, if you go through 2 pages or 3 pages also every day, you will remember a lot.
I don't think I have it.
Yeah,
Okay.
it's not on the LMS.
Okay, I'll share it. I'll ask them, or maybe I'll share it in the group myself. So till now we have come across 2 acronyms till now: Craft, Krems, Vens, Drills, and Mudpiss. Then we have also come across one more, Venom Adda. Okay. Now, what are generic rating factors? Sum insured, exposure measure, exclusions, policy limits, excess, past claim experiences. The chapter 3 covers insurance products. So all type of insurance that we have. So we have discussed that there are general insurance products can be divided into 4 parts: liability, property damage, financial loss, and fixed loss. Okay. So I request you guys to please go through these products and get a good idea of it. Here we have covered benefits, perils, basis for cover, exposure measure, risk, and rating factors for all the products, almost all the generic products which are there. Employers' liabilities, motor third-party liability, aviation liability, public liability, product liability, professional indemnity. So professional indemnity is also known as E&O, and D&O is directors and officers liability. So if you go through this, you'll notice that D&O and E&O are almost similar, but there is just a small difference. D&O is taken by the company itself, and E&O is taken by the person. Okay. So D&O involves 3 parties. Like I said, that it is taken by a company, and E&O involves only the policyholder and the insurer. So D&O liability structure of the cover is as follows: Side A, coverage for individual director, either due to legal requirement or potential inability of the company to pay in the event of a claim. Side B, coverage for the company where it indemnifying the directors of the company, coverage for the company to protect against securities actions. So basically, D&O indemnifies the insured against the legal liability to compensate third parties owing to wrongful act of the insured in his or her capacity as a director or officer of the company. And it is usually bought by the company. Deliberate fraud, like if any fraud is being done by the company and it is deliberate, then those are under exclusions. Employment practices liability, pollution and environment and pollution liability, cyber insurance. So in this, if I talk about the environment and pollution and cyber insurance, will be more upcoming than already established products like motor insurance, employers liability, D&O, E&O, public liability, product liability. Okay. And what is the basis for cover for most of the Then there is silent cyber. Like cyber insurance is relatively new as compared to any other type of insurance. So what was previously done was it was assumed that it is already covered in the existing policies. Like silent cyber claims would arise when the policy coverage and condition neither explicitly cover nor exclude cyber risk, causing uncertainty in coverage and claim settlement report, resulting in potential disputes. Silent cyber in a property insurance portfolio can be referred to as cyber exposure that are included within the traditional property insurance market, mostly as a residual cyber cover. The property insurance cover may not be clear about coverage for a loss of cause triggered by a cyber event, a fire caused by a malware attack to a programmable, controllable of a facility. So as previously, it was not known whether cyber insurance, like if we talk about maybe 10 years or 15, 20 years before, cyber or the internet was much not developed, so nobody knew about cyber claims. So it was neither explicitly covered nor it was excluded because nobody thought that it would come up. Like it was something unknown. Like if we talk about like asbestos related claims, maybe nobody knew that something would come up in future like that. So it was not excluded, not included. So that was similarly, that is silent cyber is also something like that, which has come up in recent times. And we have property damage. So what are the characteristics of property damage? They're usually short-tailed, reported and paid quickly, more predictable in frequency and severity, as the severity tends to be low and frequency high compared to liability claims. Then most exposed to moral hazard. Like if we talk about maybe any motor insurance, so there is more moral hazard involved with property damage claims of motor insurance, of a car insurance, than compared to liability claim. Like in case of liability claim, moral hazard could be very low. Like how would they fake it or make the insurance company pay any claim that is not valid? But for motor insurance, for property damage, it is more easy for moral hazard to exist. Crop insurance, like extended warranty. Now we have extended warranty on almost all of the electronics that we buy nowadays. Mobile phones, washing machines, refrigerators. Like you name any machine and we can buy extended warranty on those now. And fidelity insurance, it protects individuals and businesses against various financial loss resulting from specific event or circumstances. Fidelity guarantee, business interruption cover, legal expenses cover, surety bond, credit insurance, trade credit, mortgage indemnity, creditor insurance. Creditor insurance, also known as PPI, payment protection income insurance. Hello, am I audible?
Yes.
Yes.
Okay, I think my screen, I cannot see that my screen is moving. All right, so I would like you guys to answer this question. The general insurance company has for many years sold various liability policies to banks. So here you see liability policy, okay? The company is considering extending its product range to include a policy covering risk relating to external non-physical attack on banks' data and system. Basically, cyber. They are now looking to expand the policy to include cyber risk also. Okay, so suggest losses that the bank may experience that may be covered by this additional. Like, what additional things do you think would be covered by the cyber insurance? And discuss the risk to the insurance company. What would be the additional risk that the insurance company would be taking on by introducing the cyber risk? Okay, can you attempt this question? So it is about 4 plus 5, 9 marks. So you can just give 4 points maybe for now. For 4 points, that's 8 points. So you can take 8 minutes now. So it's 5:42. We can continue at 5:50. Okay. Do we have the answers? Actually has sent. Dhara and Prerna. Okay, kind of.
Just
Yeah.
wait.
Yes. Okay, so we'll start discussing it. Okay, the question. A general insurance company has for many years sold various liability policies to banks. The company is considering extending its product range to include a policy covering risk relating to external non-physical attacks on a bank's data and systems, cyber risk. Okay. So suggest losses that the banks may experience that may be covered by this additional product. So loss of financial data. Okay. Fraud payments to third parties. Correct. Bank IT damage. Risk of client data leak. Correct. So data privacy. Data privacy. Okay. So what type of data may be stolen basically? Customers' personal information, customers' bank details resulting in financial frauds. Okay. Damage to systems. So unable to carry out usual business. So basically business interruption. May have to pay customers for compensating for payments that they couldn't make. All right. Random notification emails sent to customers, ransomware or malware attacks, fines, penalties from regulators. Makes sense. Losses or theft of customer data, fraudulent transactions, increased admin cost due to cyber attacks or risk. Yes. So now if we were to combine all of these answers, I think we would have around 8 points maybe to get 4 marks on it, right? So then the second part, so we'll also see what is there in our answer.
Question, so suggest means 1 point, or is it like list?
Not list. You don't have to just maybe list and a little explanation.
Okay.
Not a lot, just a little explanation.
Okay,
Because
so
if
like
the second
ideally
one is- the
4
second one
points,
is-
but we'll just write more. That's how
Right?
it is.
Yes.
So ideally it is like 4 points required, but we can write, like we should write more.
Like 4 points, 4 points would not get you 4 marks. 4 points, you 2
Okay.
marks.
Okay, got it.
So you always have to double it down, okay? If it is 4 marks, you have to write 8 points. So we'll see what is there in the answer also. 1 minute. So this is the answer. Okay, maybe I'll present that screen only. Just copy paste. So the answer is loss of transactional data, loss of account balances, fictitious transactions, fraudulent payment to third parties or theft of client money, costs associated with identifying repairing of breaches, any damage caused to bank's computer system, as we said IT damage, Business interruption losses will is the bank system are down, following an attack, and the bank cannot function normally. Any cost associated with the loss of client confidential information. So I think we've already covered all of these points here. Okay, moving to the second part. So what would be the risk the insurance company would be facing if they introduce this cyber risk in the new product? So our answers are cost arising from IT system, losses from bank website, Anjani, I'd say you have to answer it if I look at this thing, no, the cost arising from repairing the IT system, I would think like it is more towards the first part. Like maybe, right, the insurance company will have to cover cost, cover additional cost arising from the IT system. Like cost arising from repairing of IT system can be in both parts, right?
Yeah, it would like be further explained to support this part of the answer.
Yes. So you'll have to write a little bit, frame it in a better way.
Yeah.
Okay. Losses from bank websites and app disruption, cost of from missing use of bank email address, compensation payments to customers affected. So if I look at the answer correctly right now, I would see that this and the first answer do not differ a lot. Like obviously, in the first question, we are asking what are the additional losses that the banks that would be covered, and what is the risk to the insurance company. Okay, so one or the other way, almost it is similar, but you have to write it in a different way. Okay. Currently, if I look at the second part, I would not think I'd be giving any marks here. Cost of setting up, cost associated with reputational damage, risk to insurance company, reputational. This is Prerna's answer, I think. Yes.
I think I also read the question a little wrong. Like at some point, I started thinking it's risks because of the cyber attack compared to the new product, but maybe like some points might be fine. Premium risk, market risk.
Yes. Okay, reputational risk, loss of business due to business interruption from cyber attack, market risk, liquidity risk, ransom payments can be too high, like may not be able to retrieve data. Okay, and Dhara's answer, risk to insurance company, moral hazard, bank staging. This is like very probabilities, I think, are very, very low. Why would any bank would do that? Because they will face a lot of reputational damage because of it. And I would not suggest to keep it as the first point, Dhara.
Okay.
It's subjective. I don't think I would have included this because the damage to the bank's reputation is very high compared to the amount, or their reputation would be severely damaged if they stage it or they are making look that their bank is not safe for people to keep their money.
No, but like the way I was thinking is, like the banks won't publicize it that the fraud has taken place, but it will just be between the policyholder and the insurer.
No.
So
in this digital economy, how do you think it's possible right now? And no bank would it would come out some way or the other, and no bank or no financial institution would like to show that their institution is not safe for people's money.
Right. Yeah, makes sense.
Okay, even if I think it's a very it's a debatable answer, we can say, but I would not risk it putting as the first point because it somewhere sets the tone of the examiner.
Yeah.
So if you have any such point which is it may be or may not be, don't I would not say don't write it. Write it at the end, towards the end maybe, because any point that fetches you marks is good. Okay. Adverse selection. Banks that probably don't want to invest much in cyber safety measures might go for it. Okay, pricing risk, since it is a relative price. So yeah, so pricing would be a good point. So we'll just see what the answer for it is. Okay. This answer is also, I don't think it's framed completely very good, in a very good way, but still, I'll just. Okay, so what are the additional risks that the insurer will be taking on? Any costs associated with the damage to the bank's reputation and subsequent loss of business or profit. Any cost arising from the misuse of bank's email system. Cost arising from transmission of a virus to third parties. Cost incurred repairing the damaged affected customers. So like they are mentioning it to the bank's reputation, and like it shows that it is for the insurer. If we look at the point. Like if we look at this cost arising from repairing of IT system, like we do not understand this is a risk to the bank or to the insurer. Here we have written cases for banks, damage to the bank, so it's being incurred by the insurance company ultimately. Okay, any losses from interruption to the bank's website and other technology associated with loss of bank's intellectual property, compensation payment to customers. Okay, so more or less the first and second answers are interlinked, but you just have to frame it in a better way. So, my camera is not working. I don't know why. Okay, moving on to the SP7 course. Now here we have, so chapter 4 is just problem solving, so you can go through that, how to work on it. Chapter 5 and 6 is reinsurance. Okay, so we know reinsurance is basically insurance for the insurance company, and reasons for purchasing reinsurance: past life, basically to increase profitability, avoid single large losses, smooth results, improve the solvency, limit accumulation, increase capacity to accept risk, financial assistance, and expertise. Additional expertise, like if insurance company is starting any new product or new type of risk, they are new product they are introducing, then they would take help of the reinsurance companies to price it or to how to sell it or any other type of expertise that the reinsurer can help with. What is retrocession? Retrocession is reinsurance for the reinsurer. Okay. Retrocession is also a form of insurance. However, rather than being sought by individuals or insurers, it is bought by reinsurers. Retrocession is a reinsurance of reinsurance and is a very specialist area of insurance market. A retrocession protection is necessary where a reinsurer that accepts substantial amounts of reinsurance business requires reinsurance protection itself. The ceding reinsurer is a retrocession. In retrocession, okay, yeah. So who are the participants in the reinsurance market? Brokers, direct reinsurers, fronting, and captives. So do you guys know what is the fronting? What is fronting? Like yesterday we discussed captive. What is captive? What is fronting? Do we have an idea of it?
Reinsuring the
100% of the business, like of apparel or line or region.
Okay, yes. And Anjani?
yeah, I was saying the same thing. Reinsuring 100% of the business book of business.
Yeah, almost 100%. So, why would any company reinsure 100% of it, or why would any like reinsurance company accept 100% of the risk?
The insurer might not want to insure that particular peril, but it might be included in most of its policies, or maybe not want to have a company in a new region, but not want to lose customer base. And
All right.
reinsurer will just get more business.
All right.
Regulatory arbitrage as well can be a reason.
Can you expand on it?
For example, Bermuda. So like the insurance company can charge a lower premium and then reinsure 100% to a reinsurance company based somewhere which has got supported like favorable regulatory.
This is how you cover a
Okay, got it. Makes sense. Okay. So the first most important reason, that comes to my mind when any company would be using fronting, like if I am an insurance company A, I am already in country A, but I want to set up in country B as well. So instead of directly selling insurance there, I can use the insurance company that already exists in country B to sell the insurance there, and they can give me the 100% of the risk. So in that case, I will get the expertise of it, and I will not have to basically have to go through all the regulatory requirements in the new country. Okay, so in in those cases, most of the time fronting is being used. So there are two ways of writing reinsurance business, that is facultative and treaty. So in facultative, each of the risk is being, so there is contract for each risk that is being reinsured, and treaty, a group of risks are reinsured in one single agreement, arrangement, or in a single treaty. Then fronting, fronting occurs when an insurer, acting as a mere conduit, underwrites a risk and cedes all or nearly all of the risk to another insurer. The ceding of fronting reinsurer will typically receive a fee for its involvement to cover its expenses and profit. Main reasons for fronting: reinsurer may not be licensed to do business in such territory legally. Tax advantage, like you said already in Bermuda. Credit rating, like in particular LOB, my credit rating might not be good, so I'd be using fronting. Or for relations. Other reasons for fronting: it may be simple in other jurisdictions and may not want to set up a subsidiary in the country concerned. So these are basically the main reasons for fronting. And are we clear between the difference of fronting and the captive?
Yes.
All right. Okay, so yesterday we had already talked about proportional, non-proportional reinsurance basically. Then, so both are written risk attaching, but one is risk attaching and risk attaching during, and this is according to accident period. Okay. Then we have claims made also. So there are three different bases of reinsurance. So this is not risk attaching. It should not be risk attaching. It should be
losses occurring.
Yeah, LOD. Okay. Yes. So one is RDD, one is LOD, and one is claim made. So these are three different bases for reinsurance. So risk. Do we need to go further in it, or are we can move forward? I'm taking it as I can move forward. Okay. And then reinsurance products. Proportional, we have quota share, then we have surplus reinsurance. And then XOL reinsurance, financial reinsurance, run-off reinsurance. Okay. So we had talked about XOL. So today we'll go into financial reinsurance and run-off reinsurance. So financial reinsurance, they basically differ from the traditional reinsurance products, and the aim of financial reinsurance tends to be risk financing rather than traditional risk transfer. So how do we finance it? Pre-funded agreements, post-funded arrangements. Like typical type of financial reinsurance, these are the two types, pre-funded and post-funded. So in pre-funded, what happens? Insurer pays premium into a fund held by the reinsurer and claims are paid from that. And post-funded is where the reinsurer pays the losses and the insurer pays back the losses over time. Okay, these are some of the names of financial reinsurance, but you do not have to go too deep in it. Just have an idea that apart from traditional reinsurance, these methods might also be used for reinsuring. Industry loss warranties is something that has previously also come in exams as well, where the basis of cover is not indemnity, repayment of actual losses suffered. Then run-off reinsurance. So run-off reinsurance is of two types. One is adverse development cover and one is so there are two types, LPT and ADC. Loss portfolio transfer and adverse development cover. Okay. The reinsurance of a closed tranche is one possible of run-off solution. The aim of run-off reinsurance is to transfer the reserve development risk. Okay, it provides cover against the insurer's earning volatility arising from past activities. So, what happens in run-off reinsurance is basically maybe we have closed a book of business. Suppose we have a company A, which is a very large insurance company, general insurance company. It sells many lines of business. Previously, maybe it used to write a small portion of home insurance. But now they have closed that book. They are no longer writing further any new policies in it. But as it can be, some of it may be long-tailed. So some of the coverages, perils that it may cover may be long-tailed. So it may take years for it to run off, completely eradicated. And even after many years, after 5 years also, they might not be able to close it completely. They will have to maintain capital for it. And there is a risk that any new type of claim might come, which may lead for old previously written policies to make claims, and for the insurer may be held liable for those. So in order to protect one in these cases, now if I take the example of maybe employer's liability cover, if it was previously writing employer's liability cover in the US somewhere and they had stopped writing it, if they had not taken off run-off insurance and after 10 years, maybe now also an asbestos claim had arisen, they would have to pay for it. But if they had taken ADC or LPT, they might have be protected against adverse development of those risks, of those reserves. Okay, so ADC is basically cover the ultimate settled amount to a specific block of business above a certain pre-agreed amount. Like, yeah, I have closed the employer's liability book, okay, maybe 10 years ago. I have taken out ADC and I had taken out an adverse development cover. Okay, so I have taken out adverse development cover, suppose maybe above 10 million. Now, if I get any claims of which are more than 10 million, or it may be aggregate or maybe for single claim. So in those cases, if after 10 years I'm getting a claim which I'm liable to pay, then I'll be limited to 10 million. After that, any amount would be paid by the reinsurer. That is ADC. Then LPT is that the complete. If I had taken out LPT instead of ADC, what would have happened is the complete book would have been transferred to the reinsurer. Excuse me. Yes, the complete book would have been transferred to the reinsurer, and I, as an insurer, would not be liable to pay anything. Okay, so it is a type of novation, and will come in the term novation and exiting the business in the last chapter, which is the exit strategies in SA3. So the main problem with LPT and ADC is LPT, we need court approvals as well. For ADC, we do not need court approvals, and LPTs can be very expensive compared to ADC. All right. Then general insurance markets, proprietary mutual, GI companies. We have already discussed those. Then London market, Lloyd's. So we'll be doing Lloyd's and London market in full. We'll discuss it in deeper in the next class, as it is covered in the second chapter as well in SA3. Okay, we have discussed captives, P&I, mutual insurance, regulation. So what are the principal aims of regulations? GRIP, give confidence, reduce financial crimes, inefficiencies in the markets are corrected, protect consumers. So cost of regulation, there are two costs. There are direct cost and there are indirect cost. Cost of direct cost would be cost of the regulator administering the regulation, and the firms cost associated for the firms to comply with the regulation. Indirect cost, reduce competition, reduce product innovation, behavior of the customers are altered, reduction in customers, market's own consumer protection mechanism. In forms of regulation, it can be prescriptive, freedom of action, and outcome based. Self-regulatory regimes, statutory regulations, voluntary code of conduct, unregulated market. So we have a lot of acronyms here. It's not necessary to remember all of these. Just have an idea, like what are the objectives, what are the advantages, and why regulation is needed, and different types of regulations which are there. Moving on to chapter 9, which is external environment. So what I aim for today is that maybe we complete till some 1 or 2 chapter, and there is one more question, one exam style question, which I want you guys to answer. Okay. In external environment, we have inflation, economic factors, legal, political, social factors, climate, environmental factors, and technological factors. So another useful acronym which will help you in remembering all the aspects of external environment that can influence the general insurers. Still cubic wage. Then we have the underwriting cycle, hard market, and the soft market. So anyone, what happens in a hard market, or anyone can explain what is our underwriting cycle? Anyone? Dhara? Prerna? Okay.
So during hard market, the profits are usually high. It's difficult for new insurers to enter the market.
Profits are high, and it's no brainer. You're saying that the profits are high and it's difficult for new insurers to enter.
Like during that point, but they will start entering because the profits, like it looks profitable, and eventually it will move towards a soft market where there are more competitors, so premiums start becoming low. It's less profit margin, and then again, like because of low profit margin, a lot of businesses would start going off the market, or it could be because of large catastrophes or any such large events which will again start pushing out the competitors or business, and the market again goes in hard market, and like that's how it keeps moving in a cycle.
All right. So we'll read through what is this in the underwriting cycle here. So underwriting cycle is a process occurring over a period of years where premium rates for a given class oscillates between a high level at the top of the cycle where the business return is typically profitable and a low level where the cycle soft market where the business is typically unprofitable. So in what happens in hard market, the premiums are very high. So the businesses are making huge profits, and whenever there are huge profits, more insurers would try to enter the market, or new companies would try to enter and take those profits as well. So as the competition increases, now this tends to go towards the lower part, that is the soft market, because there are a lot of companies now. The supply has increased, but the demand is the same, right? So the prices will now typically go down, or the coverages will increase. So in what happens in those cases again is that they are fighting for the share of the market. They, like, each of the insurer would try to get more and more of the market share. So they would push their prices down. And in that cases, what happens is that the prices would go down. The business might become unprofitable. And again, insurers might have to leave the market. So, and this cycle would go on again and again. So that is what is underwriting cycle. Okay, in hard market where premiums are high, the business is typically profitable. Premium rates tend to fall as either additional capacity enters the market in order to gain a slice of the profitable business. Existing insurers cut the rates in an attempt to increase their own market share of this profitable business. This process continues until premium rates have fallen to a level where they are no longer sustainable and the business being written no longer proves to be profitable. At this point, rates should have begin to harden as insurers will either withdraw from the market, or those that remain typically start to increase their rates. The rate at which the bottom of the cycle is reached and rate begins to harden is often increased by external factors such as large catastrophe claims, which can reduce profitability and increase the pressure on rates to harden. Okay. So here are some examples, like how might external factors influence claim data for employers' liability business. Now, if we talk about medical advances, if we have medical advances, then life expectancy increases, then the claim duration lengthens. Okay, propensity to claim. Now, if there is like more propensity, like whenever we sell any product, whenever if you read through the characteristics of the product liability insurance, you'll see whether they have the US coverage or not. If they have US exposure, then what happens as there is higher tendency to claim in US, so the rates of products where for product liability where the products are sold in US also, the rates are high. Okay, so if there is higher propensity to claim, then the frequency would increase. Then legislative political changes. If there is health and safety increases, then the claim frequency may fall. Compulsory limits, then judicial decisions are there, then there may be accumulation. Like any important judicial decision is taken on any liability claim, then it affects not just one liability claim, it will affect many of the liability claims which are open. Okay, so that is judicial court inflation. That is also one type of inflation which is there. Emergence of new type of latent claim. The best example is asbestos. Inflation, court award inflation, wage inflation. So these all would increase the claim severity. Now, as we have underwriting cycle, we similarly have reserving cycle as well. So that also goes in conjunction with the underwriting cycle. Okay, recent studies have suggested the existence of reserving cycle, which is highly correlated with the underwriting cycle. This appears to show that in a soft market, incurred claim development patterns are slower to develop or longer tail than in a hard market, so that an unadjusted protection can underestimate ultimate claims in a soft market. Like, if we talk about whenever we are in the soft market, what happens in the soft market is that many of the loss-making insurers have exited, or the prices are not being profitable. So in what happens in those cases, the clean cut development tends to be slower than compared to in a hard market. Okay, so the potential reasons would be that in a soft market, in order to gain more market share, the terms and conditions might be weakened. Less conservative approach to reserving might be taken by the insurers, or more disputed claims. Like, more of the claims would be disputed by the companies. They would like to reject many of the claims. So there will be disputes between the policyholder and the insurer. Other potential reasons for the reserving cycle include, in soft market, more multi-year contracts tend to be written, more optimistic reserving basis. Business plans tend to be more optimistic. The evidence of a reserving cycle is more noticeable for businesses which is already thought to be of long tail. So liability classes face it more than property damage or short tail classes. So we'll do Lloyd's in the next class. What's the time? Right. We have half an hour. You can just go through this chapter, risk and uncertainty. So what are the risk and uncertainty? So there is another acronym here, Mr. DAMP. So model error, random error, data errors from systems and procedures, adjustment factors, market conditions, parameter error, and portfolio movements. So these are the uncertainties or risks faced by a company. Okay. So risk, like any process uncertainty, can be happen due to internal sources as well as external sources. Then model uncertainty, whether the model is correct or not, the parameters are being used correctly or not, the simulations are not too many or too few, whether there are any bugs in the model, whether the correlations have been done correctly, whether parameters are used, whether all the assumptions are correct. Okay, then we have the data chapter. Interpreting accounts, going concern. So different bases, there are different concepts which are used when preparing accounts. Going concern, actual basis, consistency, prudence and realization, separate valuation of assets and liabilities. And these are some of the key ratios which are there. Like, I think you all must be aware of these ratios: claim ratio, expense ratio, commission rate, combined ratio, solvency ratio, return on capital, investment performance, proportion reinsured. Okay, so I think, like, if you go through these chapters, which is chapter 1 to 14 and chapter 27, a thorough idea of SP7 and most of SP8 would also be taken into, like, we'll be okay with it. In the next class, we'll be doing Lloyd's. And for now, I would like you guys to answer one more question, which is an exam-based question. Yes. So, if you read the question, outline the advantages and disadvantages of insurance legislation that sets out maximum premiums. Yeah. Outline the advantages and disadvantages of insurance legislation that sets out maximum premium, requires gender neutral pricing, uses a standard formula for determining solvency requirements. So we know that for solvency, we can either use a described formula, standard formula, or we can use internal model. Like we have read it, I think in CP1 we had it. Just if you do not have the idea also, but so this is a question for 12 marks. It is divided into 3 parts. So how my brain works now is 3 parts. So 4 marks per part. And there is advantage and disadvantage. So 2 marks. 2 marks advantage, 2 marks disadvantage. So 4 points basically. Okay. So like if we look at this question, it is not anything specific, like not specific to any of the particular subject like SA3, SP7, SP8. This is a very generic question which might come. So I would like you guys to answer it as of 12 marks. It's 6:34 here right now. So let's take 45, 50. Let's get back at 6:50. 15 minutes. Okay. Just think out, write out the basics advantages and disadvantages. All right. See you at 6:50. Do we have the answers? Or you need 5 more minutes? Okay, I see. Prerna has sent her answer. Anjani, Dhara. Yes, one more. Anjani's answer is also there. Dhara's answer is there. Okay, so we'll start with the first part. Okay, so let's start with this maximum premium. So what would be the advantages and disadvantages? I outlined the advantages and disadvantages of insurance legislation that sets out maximum premium. So the first advantage would be that it will protect policyholders. So this answer was by Prerna, I guess.
Yeah.
Yes. So like you can write it not just protect policyholder, like it is outlined. So you can just say that outline protect policyholder and against excessive premiums charged by insurer company. Like okay, then easy to regulate. Like just a little elaboration, not just list, not just list. It's not list, no?
Oh, okay. Yeah, I thought list and outline are similar.
No. Just there's a little slight difference if I say. List में just you can write that to the point. But outline में हल्का सा इसको लिख दोगे, थोड़ा सा one liner बना दोगे instead of 2-3 words, it would be better. Okay.
Got it. Okay.
Yes. ठीक है. Protects policyholders, easy to regulate, easy to administer. Can be used by new companies to use it while pricing their product. Might not have enough data or expertise and use maximum premium as a reference point. Okay. Negative could be same maximum may not be appropriate for different companies. Okay, there may be adverse selection. So you'll have to expand on this adverse selection point, give an example or something.
Okay.
Maximum set by regulators may not be sufficient, have less expertise than insurers. Okay. So these can be like two different points if I talk about it. The maximum set by regulators may not be sufficient, like it may be too low and insurance company may withdraw their products. That can be, and this can be as the maximum is set by regulators, they are not expertise and they might not have that much expertise as compared to the insurers themselves.
Okay.
All right. If too low, insurers may start, like you have written it in the second part, but
yeah, got it.
If too low, insurers may start leaving the market. Less availability of insurers for policyholders, regulation may do more harm than protecting policyholders. All right. So 1, 2, 3, 4, like so for 4 marks, you'll be getting 4 marks each, right? So for 4 marks, you'll have to maybe write more points. Okay, the thumb rule I say it is like you have to. No. Okay, it's okay. Like I mistook it. So it's okay. You need 8 points. You've written 8 points. Like if you can write a little bit more, if you have the time and the permission or have the ideas. Okay.
Okay.
It's okay. Then we have Anjani's answer. Advantages. Protect consumers from exploitative pricing, improves affordability and access for people in all income group, increases public trust in the market, political acceptability, reduces volatility in premium prices. Okay, disadvantage, if the cap is very low, then company might face losses. Insurers may withdraw, less innovation in product design. Okay. So, Anjani, you will have to write maybe 1 point more in advantage or 1 point more in disadvantage. We have written 7 points here.
Yeah, I could not think of a point at the moment.
Yes. But I think like when we are discussing the answers, you have seen what Prerna has written. So I think it might help you.
Yeah.
Maybe you have written about selection, regulation. Like I said, regulation and like these are very easy marks and easy to miss points. Then Dhara, you'll have to improve. You've written 1 point. Policyholders are not overcharged. Insurers may not be able to cover all perils. So it's okay, as we are just doing it for the like these are practice questions, but for practice questions you have to come up with more points, Zara. Like it is a comparatively easy question and more of a generic question than anything related to our course or any particular chapter. Okay, so you'll have to come up with more points, I'd say.
Yeah.
Okay, we'll discuss the answer which is there. So this is the answer which is there. So they have not specifically bifurcated the advantages and disadvantages. They have written it together. So this is also one approach which you can use. Okay. So first of all, for maximum premium, that the premiums are affordable. We have written that consumers will be protected, but so the first thing, why would there would be maximum premium or set on maximum, there is a cap on the maximum premium that can be charged so that it can be affordable and more people can buy it. So this is a very basic point which we have not written. Okay, we have written that to protect policyholders, we have written from exploitative pricing, but we have not, so we have written affordability. So sorry, we have written affordability, but yes. So like these points. So if you write the most basic point, you'll see that they have given 1 mark for just this. So in SA3, when you go through the marking scheme, you'll see that some of the points can fetch you 1 mark as well, not necessarily half marks, but the very good points will fetch you 1 marks as well. So affordability, treating TCF we could have written. It could be seen as TCF, which is particularly important. Now from maximum premiums, what comes in my mind would be that for motor insurance in India, if we see it is a compulsory insurance, basically third party insurance, basically it is compulsory in India. So in those cases, the maximum premiums or the premiums are set. So it is basically important for customary compulsory classes, okay, or for vulnerable people. Makes financial planning easier as removes some uncertainty, may help attract business from abroad, would stifle competition. Like there is this negative point, not just that the companies would leave the market, but it may be that they may be charging the maximum premium to everyone. Then, okay, loosens pricing discipline, creativity may need to be revised annually. Like we have to think about, there is a regulation cost involved with it, right? And it's not like once they set the maximum premium, it would be set forever. They have to take into consideration adjustment, inflation and everything. So they will have to revise it. Regulatory overheads, like cost is there. If the maximum is set too low, all insurers may pull out of the class of business. Risk of insolvency increases if made unprofitable. So solvency issues we have not written out. If set too high, then pointless. We have written that if it is set too low, we have written, then we could have also thought about what would happen if it is set too high. Okay? May lead to increase for lower risk policyholders to subsidize higher risk. Obviously, whenever there is maximum or there is a cap on it, then there is always subsidy happening. Then unlikely to be relevant for commercial businesses. May create incentives to weaken their policy aspects. Like terms and conditions may be weakened, such as restrictive terms and conditions or worse service. Alright, now moving on to the next. So I'd say good answers, Prerna and Anjani. Just Dhara, you'll have to write more points. Then general neutral pricing. We have the second part. What is advantage and disadvantage of insurance regulation that requires gender? So from gender neutral pricing, what comes in mind is in the EU they have gender neutral pricing, right? So we can take some ideas from there. It can be perceived fair and unfair both, not just fair. Like if I know that for certain parts, if I am a female, I know that for certain policies, as a female, I would have fetched lower premium if there was male and female pricing. But now due to gender neutral pricing, I'm paying the same premium as a male person. Basically the smoker, non-smoker thing. So it may be fair, it may be perceived fair and unfair both, okay? So better reputation, easier to calculate since one factor is reduced, okay, easier to model. Then goes with the concept of insurance pooling. How does it goes with the insurance pooling?
Like both like high risk is not paying more premium and low risk is not paying low premium.
So that is something it will
Kind
not
of
go
like how
again.
black box,
Again,
like how. Mhm.
like if I am in the insurance industry, I would like low risk to pay lower premium and high risk to pay high premiums, right? Because there is a subsidy going on. Now it is not necessary the assumption which I am taking would happen in the real world.
Okay. Mm.
The big classic example of smoker, non-smoker. You all might be aware of this example, right?
Yeah. Okay.
Then what are the negatives? Adverse selection. Okay. May seem unfair to less risky gender. Like, yeah, it can be seen as both fair and unfair. Then companies may try to. So now in this case, you could have written. Now, as soon as I saw fair to policyholders, I did not go to this point, right? So you could have written both positive, negative together here then.
Okay.
Instead of bifurcating. Okay, may seem unfair to less risky gender, subsidizing riskier one. Companies may try to use proxies to use gender. Okay. Premiums may increase due to increased risk and volatility. Correct. Then what has Anjali written? Advantages: promotes fairness and equality, simplifies communication with customers. Disadvantage: if experience varies by gender, it may be unprofitable for the company, or conversely less competitive pricing. May encourage anti-selection. Insurers may have to look for other proxy variables. Dhara has written easy to price, more neutral data volume. Okay, since we do not have to divide it into two parts, so we'll have more data there. But that data would not be homogeneous. So that is something we'll have to look into. Maybe perceived fair to policyholders. Disadvantage: not fair if the extent of risk differs for men and women. Hence, one gender might be charged more than their actual exposure. All right. Let's see what's there here. Okay. So gender neutral gives the instead of writing it is fair, we have to write it is perceived as fair. Okay. I was also reading this. I'd written it is perceived as fair. Because if we think about it, now we know how it is priced, how it varies and everything. We are actuaries. So they expect answers not just from the view of policyholders. They expect answers from the view of an actuary. So we have to write it may be perceived as fair. Okay, not promotes fairness and equality. We have to always write it may be perceived as fair because we know that the risk varies. So it is not, anyway, it is not fair to price same for male and female. Okay, here also everyone, like in all the three answers I have written, it is fair, but it is written to be perceived to be fair. Okay, it appears to be fair. Conversely, may appear unfair. Where public are aware of impacts of gender, will meet, like I had told, EU regulation. We are like, apart from if we are appearing for IAI or if we are appearing for IFoA, we know that we have to follow EU regulation. So we'll meet EU regulations. More pooling of risk is written here, but I'm also okay. Someone who pays more, someone who pays, maybe somebody pays less if prices just go up to the more expensive gender. Now, in case of gender neutral pricing, what the company may choose that if males had to pay more than females, then they would just, in gender neutral pricing, they would put the male prices instead of making an average or doing some ratio proportion. Okay, may impact profit. Where gender is a risk factor, pricing is more difficult as need to make assumptions regarding proportions. May lose business if international competitors are not similarly restricted. And similarly, insurers could be selected against in the. So we have written selection also, we have written in the answer. So just we have to frame it properly and use some wordings, some of the words. and standard formula. So third part is advantages and disadvantages of uses of standard formula for determining solvency requirement. Easy to calculate, easy to regulate, good points. Protects policyholders from ensuring all companies have adequate capital. So, and maybe they can compare different companies. Okay. Good reference point for small or new companies who do not have capacity, expertise, data to construct models. Okay. Not appropriate for all companies. Companies which have better risk management models, data may not be able to better use internal models. Okay. Might not be appropriate for all lines. All right. Formula may be incorrect, less frequently updated with the latest data. Good points. So all of these are very good points. Advantages: easier to commute, apply and understand for small firms. Easier to compare and is consistent between all insurance companies. Less computational and modeling cost. Disadvantage: because it is not tailored to the company, it may not give an accurate picture of insurer's risk profile. Could be insufficiently prudent for some insurers. Okay. It may distort business decisions and capital modeling approach. Less advantage of advanced risk management. Okay. Standard formula advantage: easy for everyone to use. Less costly to formulate on their own. Less costly to formulate on their own. Right. Look at the answers. So this is the answer. Standard formula allows more meaningful comparisons. They've written the comparisons, particularly between similar size companies. Like they've just expanded on this point, and whenever you expand that, always write in a separate point. Even if you are giving an example, like example small firms, you should just have written it in a separate line. Okay, it just increases your chances of getting more marks. Okay, more meaningful comparison, writing small similar lines of businesses. Although, like, if I look at this answer, this is a paragraph. If I talk about it, allows more meaningful comparison between insurers, particularly between similar sized companies, writing similar line of business. Although, unless it is very complex comparison, will be broad brush. So, if we talk about these 4 points, we would have written in 1 point maybe, or 2 points. But here they have written it in separate points, so they have gotten 2 marks completely here. Maybe cheaper, so we've written cheaper than regulation. We have written less investment. Okay, then easier to implement, easier to explain. One size does not fit all, so this is a disadvantage. We do not need approval, so it is an advantage. Does needs to be revised, so yes, we have to update it. So I think it was in one of the answers, in Prerna's answer, I guess. Or I don't know. I think this less documentation, compliance issue, less data required, more transparency, may result in higher or lower capital depending on requirement, may still be considerable scope for actuarial judgment. So I'd say good attempt. You just try to change your language a little bit. Already we are 7:15. Sorry for extending the class. So I think we are done for today. I think the question, just feedback, is the question answers helping you guys, or any suggestions to make changes? Like, should I go a little fast or a little slow in classes? You can stop the class here. Just stop the recording.